There is no way of sugarcoating the market environment. Rahul Chadha as well joins in the show right now. Rahul, hi, good morning. Hope all things safe with you.
Things are tough, but yeah, all safe.
Okay, great. Literally counting down each day as it passes here in India as well. Rahul, what is playing on the market's mind? Because you've got lots of big earnings to digest, you've got the state election verdict, and then, of course, India is in the thick of the second wave right now.
I think first and foremost, again, this COVID wave is dominating the minds of investors. One is watching when does it peak. I think early signs from Mumbai, parts of the worst affected districts from Maharashtra is clearly positive. But look, the daily deaths is still a record high number. The hope is that over the next couple of weeks, one sees some bit of an peaking stabilization of this. And then once that happens, focus will come back on fundamentals. The earnings have been fairly good, but look, that's really a function of what happened in the previous quarter. Right now, I think all eyes are on government's measures to stem this big rise in deaths which has happened in recent weeks.
Yeah, indeed. So suffice to say, Rahul, one really can't calculate how much would be the downside from these levels. We're already sub 14,500 on the index and all sectors bleeding. But the upside could be capped.
So I think from a 1 or 2 weeks perspective, look, there could be downside, there could be 5 to 10% downside. But if one is willing to just look further, have a 12-month view, I think dips would be bought into because the economy is in good shape. Unlike in the past, we've not seen any significant excesses in the economy over the last 4 or 5 years. So once we come out of, again, this current wave and the vaccinations ramp up, estimates are that the vaccination number should go up from 2.5 million to 3.5 to 4 million by July, September. Things should bounce back strongly. And globally, the backdrop is very strong. So globally, if you look at the data which is coming out of US and now Europe's also following that, the data remains very strong. And with that backdrop, I think that's positive for emerging markets, including India.
Okay, Rahul, there seems to be, a dichotomy in terms of the kind of growth resurgence that we're seeing around the world. How do you see this impacting India? I mean, until a few months ago, just a couple of months ago, we were really talking about how we were on track, raised forecasts from the IMF, so on and so forth. Clearly, the latest GDP data and going forward, the impact of the second wave is likely to be a little bit more disruptive. At the same time, this is a time when people are forecasting stellar growth when it comes to the US economy. Given how interrelated everything continues to be at the moment, how do you really see this playing out?
Okay. So first, let's talk of the global backdrop. What's happened is because of the transfer of all these income which has happened to US households, there is excessive savings. And as we've seen COVID recede in US, the consumers come back strongly and then they've spent, and that's led to the sharp bounce back in the US economy. We believe that, look, a similar kind of a story may play out in India, though on a smaller scale, because we've not seen such large or such huge transfer of income from government or from state to people at large. But then, look, there is a pent-up demand. The only negative is the second wave seems to have impacted the middle class more, and that's where one was expecting a bit of this pent-up demand to come. But should this wave recede in coming quarters, we expect the pent-up demand to come back because, as we've discussed before, economy's not done anything for the last 4 or 5 years. Initially, it was demon which impacted, then was GST. So economy's not done much. We've seen a lot of positive policies from government to attract investments. That should play out in kind of a coming quarters. I think a testimony to the inherent strength of the economy is the GST numbers. The GST numbers for the month of March, which were declared in April, are very robust. I mean robust, and they seem to exceed most expectations. So there is an underlying strength of the economy. The hope is that if we control COVID in kind of a coming weeks, the economy can bounce back strongly in coming quarters.
Okay, fabulous. So then the natural question post that is retail, discretionary, hospitality, travel. Do you see this entire segment as a good investment strategy? Even if we're looking at it from, let's say, a little further time frame, perhaps a little later in the year when things actually pick up. Right now, we're already seeing the impact. We had an Indian hotels report, and we finally saw them actually see a dent on the back of the pandemic, and it's likely to continue for a couple of quarters.
So regionally, we are more kind of an open towards this reopening trade because if we see in North Asia, economies like China, Korea, Taiwan, they've controlled COVID well, and that's where reopening trade, which has been out of favor, which is in favor of financials, which is in favor of some of these tourism names, have done well. India, part of this trades got impacted because of this recent spread of COVID, but that's where the value is. So if one is looking from a 12, 18 months perspective, I think there is deep value in banks. Near term, these names can easily correct by 10%, but if you look at the quarterly earnings and we look at the provisions they're carrying, these guys have reasonable amount of provisions to take care of a COVID wave, which is a month or too long, but obviously beyond that, it impacts their earnings also. So financials come as a good proxy. We don't have many tourism name outside a couple of hotels listed in India. So that is something one can selectively look at over 12, 18 months. A lot of these consumer discretionary names had run ahead of fundamentals. Auto names were expensive. I think this pullback gives an opportunity to buy into some of the quality consumer discretionary names. So one would not be too negative on the market. That's what I'm trying to say. One is waiting and watching this COVID situation, and if it plays out like the way it's anticipated, that one gets a peak in next 3 to 4 weeks, the idea would be to move towards domestic cyclicals, take some money off the table from global cyclicals like of tech materials, which have done very well in last 6 months.
We've been accustomed, Rahul, morning to, steady FII flows since the start of the year, and that, of course, came to a grinding halt owing to the kind of COVID situation that we've seen play out in the country. Just to put it into perspective, for the month of April, it was an outflow of about $1.2 billion. What's the sense that you're getting when it comes to the interest from foreign institutional investors for our own markets, given the way the second wave has really, thrown things out of whack, if you will?
So obviously, most of our clients like India as a market from a medium-term perspective, and like the way you rightly said, people have been shocked, worried by this huge second wave which has happened, and the loss of life. It's kind of a cause, and that's where most investors are on sidelines. They want some clarity on how it's going to get handled, and as we see renewed efforts from government in coming weeks to handle this, I think that's where people will get comfort, and with the backdrop of hopefully attractive valuations in a couple of weeks from now, kind of a global economy which is on the mend, on the repair, strongly bouncing back, I think we should see more flows to India from July onwards, June, July onwards.
Okay, so we'll just have to wait a couple of months before flows stabilize, according to you. And when it comes to the entire, positioning of stocks in the portfolio, do you think that we will see investors leaning more toward the tried and tested, hefty blue chips in the portfolio, or is there a lot of opportunity at a time like this as well to dabble in interesting mid-cap names with robust balance sheets as well as healthy fundamentals?
So what we've seen is post this little correction which has happened in last couple of weeks, the blue chips have become very attractive. So blue chips across financials are very attractively valued. And ideally in a sector like financials, you will first add to your exposure in the blue chips because there's still a fair bit of an uncertainty on the damage from the second wave, which has hit the urban India very hard, which has hit the middle class very hard. So what kind of impact it has would be only seen in coming quarters. Outside financials, I don't think most mid caps offer a good risk reward at this point of time. So one would wait for a better entry levels. I think there is a reasonable amount of downside protection in large caps. So that's where we find more value.
I just want to draw your attention to, yesterday's Berkshire AGM as well, and what Warren Buffett had to say about Fed as well as, money printing. And he says that the policy of Fed and stimulus packages passed have done a tremendous job of propping up the economy, and that the government learned their lessons from the recession in 2009 and acted rather quickly. Just to put that into context as to what could happen in India, while we've already seen large stimulus allocations to the Indian economy, but perhaps now after the second wave, we'll need another round. That said, it's going to cost the exchequer, weigh in heavy on the fisc as well. Would that be taken in the right light, though, by the markets, whenever down the line, if at all, it happens?
So I think that's going to be seen. So first and foremost, what markets are going to deliberate is the hit from the second wave. How serious is the hit? What is the kind of sound bites, anecdotes we're getting from the ground from July onwards? See, right now, corporate earnings have been very strong. So if we see for last 6 months, India along with Korea, Taiwan has seen big earnings beats, strong earnings upgrades. So I think markets may go on that momentum. There is a fair bit of an lack of clarity on what's happened in April, May. We've seen earnings downgrades happen. We've seen volume numbers being impacted for most auto companies. I think we'll get a better hang of it, better clarity on this as we move towards July. I think as COVID comes under control and overall people realize that, look, global growth is strongly coming back, markets will be willing to look through this temporary increase in fiscal spends, fiscal deficits, with the basic kind of a caveat that government is doing the right thing to enhance the competitiveness of the economy, to make it a better place for manufacturing, to attract more FDI. So if the government is doing the right thing from a medium long-term perspective, market would be willing to overlook the short-term negative of higher fiscal spends or higher fiscal deficits.
Okay, just want to quickly mark the markets because we've bounced just that wee bit from the lows, the opening session lows, wherein we saw even a breach of 14,500. So near about 14,550 for the Nifty futures right now. Marico, Deepak Nitrite, IndusInd Bank, Naveen Fluorine, Exide, these are the names which are actually pushing higher. But AU Small Finance, Amara Raja Batteries, Titan, or for that matter SBI, Hindalco, they've not seen a material recovery coming in, nor has Reliance Industries. That also after its numbers, okay, I stand corrected, Reliance also has bounced back after its opening lows, but we're still down about 1% on RIL after its numbers, which was a muted quarter. Rahul, you were mentioning the point that if there is indeed a further correction in the market, 5 to 10%, who knows, we will see that dip getting bought into. But we all also know that the market is not going to react to the same event in the same fashion. What happened in 2020 in May onwards is not going to replicate itself this time around. Where do you think buying will actually come in, and where will money gravitate to if there is a deep cut to the tune of about 5 to 10%, which does take place from these levels?
So with this COVID kind of news coming through, I think financials, despite strong earnings, strong beats, have bore the brunt of this. And I think that's what would be the sector which would bounce back fastest as markets get the comfort that the worst of the COVID is behind us. We see some bit of an visibility in terms of the ramp up in daily vaccinations. I think financials is where we have a very favorable risk reward. And then highly likely that financials would be followed by consumer discretionary, particularly some of the quality auto names which have corrected or may correct in coming weeks. Industrials, we've not seen much pullback on those names. Those are not very liquid names. So I think nothing much happened over there. But financials and autos would be two sectors which would be bought into once market gets the confidence that we've seen the peak of this wave.
Sure. But within financials as well, Rahul, given that it's such a large pool of BFSI as a sector, where do you think the recovery is going to come in? It was an excellent quarter and a commentary coming in from lenders like Bajaj Finance, for instance. What one is also seeing within the private banks, which have reported their numbers so far, that it's more the corporate end and, the corporate lending heavy banks which are seeing a stronger recovery, and retail is bound to get hit because, especially now with the second wave playing out the way it is. So again, where within BFSI are you tilted more towards?
So corporate banks is something we've liked for last 6-9 months. Look, the valuations are not expensive over there. Corporate banks are the biggest beneficiaries of this pickup of inflation. The global backdrop, and the same is playing out in India, is that, look, the central banks, the governments are willing to live with negative real interest rates because they want economies to come back on track. They want economies to lever up. So I think that's very positive because what that would lead to is inflation. What that would lead to is pickup in nominal GDP. And corporate banks are the best way to play. We've seen a lot of these banks adequately provide for the NPS of last 5-7 years. Last couple of years has not seen any significant growth in credit for them. So it's a new cycle for them. So corporate banks should be good. A lot of these guys have cut their costs. They're at the forefront of digitalization initiatives. CASAs are in excess of 40%. So I think corporate banks, if the recovery story plays out as one is envisaging, can easily give 30 to 40% over the next 12 to 18 months.
Rahul, you mentioned domestic cyclicals. How can we narrow this down a little bit as well? And in terms of, let's say, a percentage orientation in an ideal portfolio right now, would the balance be shifting a little bit towards cyclicals? Financials, of course, will continue to remain a big part. How would you really add it up?
Yeah. Though one has seen strong numbers for consumer staples, but look, the valuation excesses are a bit too much over there. And with this global growth getting broad-based, I think those names would be funding source. Pharma sector would be also selectively used as a funding source. And what we'll see is money move to financials, autos, which are part of domestic cyclicals, industrials, the construction names like Larsen and other and capital goods players. They should be sought into or bought into from next 18 to 24 months. So these would be the broad-based plays, basically.
Okay, fabulous. What are you making of the entire IPO market, Rahul? I'm just curious to get your opinion, just even as a spectator, given the kind of buzz around it and the way things are heating up in the second half of the year, some big bang issues that we're watching out for.
Yeah, so again, clearly what we've seen is quality IPOs always attract new set of investors to the market. They are good opportunities to study these companies, interact with the management. If the valuations are expensive, which it seems like because they are coming from hot sector, so valuations would not be cheap. One can build small positions, and over the next 1 or 2 years, as one get good entry points, as one get more confidence on these business models, one can increase those positions. But look, it's always good that when one has new high growth companies getting listed.
Okay. Is there a concern when it comes to the infrastructure and real estate basket with respect to overall execution slowing down on account of the second wave of COVID? Or do you think that as things start opening up and hopefully when we see a reprieve, that things will definitely get back on track?
So we've liked the real estate names, and these names did exceptionally well over the last 6-9 months. If you look at the quarterly earnings, the sales these guys had, December quarter was a good quarter for them, and same with March quarter. It's been a record quarter. So obviously these names would get negatively impacted for 3 to 6 months. But unlike in the past, these names have held on very well. I mean, nobody would have thought that a real estate name with such spread of COVID would be down only 10%. So these names have held on well, which is where I think somewhere investors are smart enough to see through this near-term negative and see to the longer-term potential of these few companies consolidating the sector, basically affordability being a 15-year high, and this whole kind of an sense we are getting from ground that people want to upgrade their houses. Staying at home means people realize that, look, you need bigger homes, etc. And all this is favorable for the sector. So we continue to like the residential players in real estate sectors. In fact, what we've what we've done and would probably continue to do is slowly add to our existing positions should we get better entry levels.
Chatting with you, Rahul. Thanks very much for giving us a flavor as to where you see opportunity, the outlook on valuations, as well as fund flows.